corporate finance practice problem using OneNote, estimated earnings per share, and dividends. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote and would like to follow along, you're not required to, but if would like to, we're going to be in the icon on the left-hand side. We're in the practice problems area down in the 1041 estimated earnings per share and dividends tab. Also note that when using OneNote, look at the immersive reader because it's an excellent tool. Many of our presentations up top will be mirrored down here in the text area. The text area having the same name and number within them, those being transcripts that can be translated into multiple different languages and either listened to or read in those languages, thereby being a good complement to the presentations up top. Closing out the icon, we have our information on the left. We will populate this information into the blue area on the right-hand side and then down below. So we're talking about the estimated earnings per share and dividends. We're going to be taking a look at past data for the performance of stocks and then considering what we can gain from that, thinking about what's going to be happening into the future for the earnings per share and dividends estimates and calculations into the future. So prior year data, we have 2000x1, 2000x2, 2000x3, 2000x4, 2000x5, the earnings per share going from 9 to 10.08 to 11.29 to 12.64 to 14.16. Now, one of the first things that we would want to do then is try to think about, and we could put this into a table in Excel and do this quite easily. We do this problem in Excel if you want to take a look at that. But we put this into a table and then we can think about what the trend is. So for example, we might say, let's take the 1008 minus the 9. That would mean that there was an increase in the earnings per share from the 2000x1 to 2000x2 of 1.08. If we did the same thing on 2000x3, taking the 11.29 minus the 10.08, then we see that there was an increase of the 1.21. Same thing down here. We're going to take the 12.64 minus the 11.29. We have an increase of 1.35. And finally, we've got the 14.16 minus the 12.64 gives us an increase of the 1.52. So we could see that trend. That's useful, but it's often more useful to see what the percentage increase could be because that can help us as we go into the future. So we could say, well, what's the trend in terms of the percentage increase? Well, then we can take the good old percentage increase. So the calculation would be looking like this. When we have an increase, we'll typically take the current year, 10.08, minus the prior year, 9. That would give us our difference, the 1.0908. That's the difference. We take that and we divide it by, divided by the prior year, 9. So we've got the percentage increase, 0.12 or 12%. That's going to be our typical type of calculation for a percent increase. Very useful calculation. It's used in many different kind of measuring tools, job performance, many different areas. So we can then do that process on down. We could say we have a very standard kind of problem here, stable type of increase. It might not always be this stable, but you can see a trend that is taking place, and then you can carry that trend into the future or see if there's any changes to the trend based on what you know about what's going to happen in the future. So in any case, we've got the 11.29 minus the 10.08. That's going to give us our 1.21. If we take that and we divide it by the prior year again, the 10.08, we get, once again, the 12%, about 0.12, about 12%. And then doing this on down again, we can say now we've got the 12.64 minus the 11.29. We've got that. That's the 1.35. If we divide that by the first period, we got the 11.29. Then we get about 12 again. Once again, about 12%. And finally, doing this one more time just for the fun of it here, because it is good times, we got the 14.16 minus the 12.64. That's going to be the 1.52 divided by the prior period, the 12.64. We get, you guessed it, about 12 again. So we have a really steady, in this case, trend on the earnings per share. So we can use that for estimates into the future. We can obviously think about what's going to happen to the next period out by applying the same kind of trend of the 12% increase at the 14.16 if we think that increase is likely to continue. So the earnings per share constant rate of growth assumed to continue. So we're going to say we think it will. We're going to assume that this 12% increase will continue. Dividend percent of earnings is going to be the 30%. So we're going to say that the percent of the dividends that are given out, the corporation does has the capacity to change, to decide what types of dividends they want to be issuing out. But you would think that they keep it somewhat stable, or they would let people know what the dividends are, or they might have basically set the dividends based on a 30% or so, or we might have to basically guess based on prior performance to see what the amount of dividends that would be given out would be. Remember, when we're thinking about these stocks, there's two things that are going to be involved here when we're talking about our return, why we're putting money into the company. One, for the actual dividend, the payment out, the return on the investment that would be, a flow to us actually, and the increase in valuation of the stocks, because that would, of course, we would assume, increase the stock price. And as the stock price increases, we could at some point in the future sell and pick up the cash flow in that format. So we have the estimated earnings per share then. We could we could just continue this trend that we have, the 14.16. That's the 14.16. We can assume the trend will continue. So I'm going to take 1 plus the 12%, meaning it's going to increase by 112%. So there's the 112%, and that would be then the 15.86. So in other words, if we expect it to go up by 12%, again, we can calculate this a couple different ways. We left off at 14.16. If we multiply times 0.12, it's going to increase by 1.6992 about. Adding that then to the 14.16 is going to give us our 15.85. Or we could say it's going to increase by 0.12, the 12%, and plus 112%, or 1.12. Then just take that and multiply times the 14.16, once again getting us to that 15.8592. That's kind of the quicker way to get to the same end result. Once we have that, then given this assumption, the 30% on the dividends, we can assume what the dividends will then be. The estimated earnings at the 15.86 times the 30% of the dividends that will then be given out. We're guessing the dividends will be then the 4.75, which is simply the 15.86 times the 0.3 or 30%, giving us about 4.76.